BMO's call is for a July rate hike, but I wouldn't take that option off the table just yet. We'll have to see what happens in June. Jennifer Lee, BMO Capital. In the US, non-farm payrolls increased by 38,000, much lower than the anticipated 164,000 increase. Will this make the Fed rethink a rate hike in June?
This was shockingly weak. I mean, everyone had anticipated some sort of impact from the Verizon strike, which would have, accounted for roughly 36,000 somewhat workers. But obviously a 38,000 increase, that's the smallest that we've seen since September 2010. So Verizon itself, the strikes cannot be blamed for this number. Just again, given the small increase in the month. And plus, we saw nearly almost every major industry cutting back in the month, from manufacturing to construction, oil and gas, of course. We did see an increase in the retail trade, the fallbacks, which is education and health services. We continue to see hiring on that front. But overall, just the breadth of the declines across most of the industries, and plus the fact that there were downward revisions in the prior couple of months, I think it gives the Fed probably reason to pause for June. I don't know if this is going to take a June rate hike completely off the table, but I think the risks have definitely declined considerably. I think in the past they basically said that they needed roughly 100,000 jobs to any given month, I think, on average, to raise rates, and obviously we didn't get that in May. But I will say this, our BMO's call has been for a July rate hike, and I don't think it takes July off the table just yet. I would say that we would have to wait until see what happens in June to the June payroll numbers and just to see how the revisions go, because this report is also quite prone to revisions. Of course, you would have to see a huge revision to May to make this work, but if you smooth out all of the monthly volatility and just look at the averages over the past few months or something like that, I think June will be much more telling, a much more important report.
Canada's trade deficit shortened to 2.9 billion loonie dollars. And with falling exports, what will be the effect on the Canadian economy?
Similar to the U.S. jobs report, the headline, was a little bit was definitely weaker than expected and disappointing, especially given the fact that we have already seen weaker numbers earlier this week with GDP coming in, at a slower than expected 2.4% rate in Q1 and seeing the economy shrink in the month of March alone. So this sort of adds to the weight on the Bank of Canada's shoulders. So for April itself, we did see an increase in exports, which is encouraging. Ditto for imports, but when you look at the real trade numbers, that's where we saw some deterioration in the trade balance. And we're seeing slower, exports are still growing, but at a slower pace. And that's where the disappointment was. And plus, we saw a big jump in import volumes as well. So I think we were already expecting net trade to cut 1.8 percentage points from growth in the second quarter. So after this number, it's probably going to be a little bit more of a deeper cut. As far as the bank is concerned, we don't see them moving at all until probably at the mid-year point of 2017. But this is something that Bank of Canada Governor Poloz is watching very intently. He wants to see a continued pickup in export activity before, for him to be more comfortable with raising rates. So this sort of confirms that, rate hikes are, very far off in the distance.
Mario Draghi said in a press conference that Eurozone inflation rates are likely to recover in 2016. How realistic are the targets they have set?
So they raised their CPI forecast just a little bit from 0.1% to 2.2% for 2016. I think that's quite doable. It's just a modest increase. And plus, I think just mathematically it should work given that energy prices are starting to pick up again. They're still well below year-ago levels, but the pace of decline is starting to ebb a little bit. So I think that should just put some more upward pressure on prices in the second half of the year. So I think it is quite doable. Now, whether or not we see their targets being met for 2017 and 2018, 1.25% inflation, I think that remains to be seen, just given that growth is still struggling considerably in the euro area, and the ECB is doing everything that they can to boost growth, to boost lending. But it's like, what President Draghi said yesterday, we need help from the governments, we need more fiscal support. Monetary policy can only do so much. So I think 2016's forecast of 0.2%, I think it is quite doable, just given the way energy prices are headed, or the fact that they are starting to edge higher. But I think 2017 and 2018 forecast for CPI, I don't know if those forecasts are quite doable just yet.
Thank you for your insight today, Jennifer. That wraps up the week. We'll see you on Monday.